Welcome to CLIC Connect. I'm your host, Craig Sullivan. We've got a great show for you today, and we are honored to have Mr. Daniel Lesser, co-founder, president, and CEO of LW Hospitality Advisors, rejoining the conversation today. I'd also like to thank Red Roof Franchising and Chicago Title National Commercial Services Group, California, for their help with this show. So, with that said, let's get right into it. Daniel, how are you?
I'm terrific. Great to see you again. How are you?
I'm doing a lot better. We don't have the haze and the smoke and everything that you've got in Manhattan right now. So we're really good out on the West Coast, and producer Danny's great up in Idaho. So we're both doing good. How are you? I mean, it's got to be miserable with all that ash and smoke in the air.
It's bizarre. I'm a born and bred New Yorker. I can't say I've experienced this in New York before, but hey, you try something new every day. But I'm looking forward to getting out of Manhattan later on this afternoon.
There you go, my friend. Hey, it's really an honor to have you back on the show. I know you've had a busy week with NYU and everything else. So for the one or two people in the audience that may not know you, would you tell them who you are and what LW Hospitality Advisors is, please?
Absolutely. Well, thank you again, Craig. It's great to be here. So Daniel Lesser, LW Hospitality Advisors. We are a professional services firm focused exclusively on the lodging sector. So think hotels, resorts, casinos, conference centers, timeshare properties. We're an organization of 40 plus professionals with boots on the ground in New York, Boston, DC, Atlanta, Cleveland, Minneapolis, Florida, Texas, San Diego, and Seattle. So we have boots on the ground all over. We have three main silos of business. Silo number one is what I characterize as a non-advocacy silo. So appraisals, market studies, feasibility studies, lots and lots of litigation-related work for a whole myriad of reasons, property tax disputes, bankruptcies, partnership disputes. It's always a thriving business in the litigation world, even in good times. You put human beings and capital together, invariably, you're going to end up with disputes. So that's silo number one. Silo number two is asset management, and we do traditional third-party asset management where we oversee day-to-day operators. Although everybody on our team are former day-to-day operators, we do not provide that service at LW Hospitality Advisors. We only provide the asset management, which is overseeing the day-to-day operator. A subsegment within asset management is receivership work. During COVID, we were the court-appointed receiver for, there was one hotel portfolio that Highgate did not purchase from Colony Capital, and we were the court-appointed receiver. It was 48 assets around the country, and ultimately that ended up after an 18-month tenure of structuring a sale of the portfolio to KKR. Since then, we've done a couple of other one-offs in the receivership world, and then a final subsegment within asset management is consulting and advisory work, but on the advocacy side for folks who we very respectfully refer to as newbies to the hotel space. Smart, sophisticated, they have money, they know and understand real estate finance, what have you, but they come up short on the hospitality expertise. That's where we come in. And then the last silo is a predictive analytics platform, LARC, Lodging Analytics Research and Consulting, which if you're not familiar with it, I highly recommend you check it out online. It's an amazing product.
There we go. I want to touch on the newbies a little later with you, my friend. But, if for the one or two of you that don't know Daniel, this is why he's here. Our first question really is the current state of the U.S. lodging industry. And there's nobody better to have this discussion with. Daniel, what's going on out there?
There is a lot going on. And as you said, we're just coming off the NYU conference, so lots of opinions out there. But then again, everybody in the hospitality business, I never met a hotel person who wasn't an optimist at heart, me included.
Yeah.
So, but let's face it, with that being said, there's strengths to everything, right? There's weaknesses and threats to everything. And then there are also opportunities. So maybe we'll just take a minute and talk about some of the strengths about what's going on in the sector, and then we can talk about some of these other categories.
Perfect.
Listen, at the end of the day, this is the longest predicted recession that I can ever recall. Yeah. And it's interesting. I speak a fair amount in public, and I've lately been starting off with audiences asking folks to raise their hand if they believe that we're currently in a recession. You get about a third of the room. Or I should say half the room. Exactly. And then, we're not in a recession, but you think we're going into one. Raise your hand. And then after that, I ask, okay, and who has no idea? And my hand goes way up.
Yeah.
So it's really kind of interesting. We've been hearing about this impending recession for the longest time. And yet, technically, we're not there yet. With that as a backdrop, right, hotel demand has been off the charts. The ability to raise room rates has been off the charts. So the outlook for the economy, and I'm not an economist, but the outlook is for continued growth of GDP, but albeit at slower growth rates. However, it's growth nonetheless. I was around in the early 90s when we had negative GDP, right? Unemployment remains incredibly low. Wage increases are pretty strong. Most companies are in good financial shape. This is really the first time that in a slowing economy, hotel demand continues to grow quite dramatically. There historically has been a good correlation between GDP and hotel room night demand. This is the first time there's a little bit of a divergence. The airline sector is on fire, right? When was the last time you flew on a plane that had empty seats, right? And if you think about it, the cost of airfare is increasing dramatically, which is a great drag effect for the lodging industry. It conditions travelers that they're going to have to pay more. So it's a great thing. Inbound foreign traffic is definitely coming back. And there's a long ways to go still because China is not back yet. Supply, in terms of new supply, has definitely been curtailed because economic feasibility is just not there for the most part. And it's hard to get construction financing. And then when you can, it's real expensive.
Right.
So that's a real positive for existing owners, right? Something else to sort of remember that's a positive for the space is that, people talk about new supply, but they never talk about net new supply, right? And when you look back, if you look back over COVID, there have been quite a number of hotels that have permanently closed, converted to alternative uses, scraped for new development. So you've had a lot of rooms come offline. What's interesting in New York right now with the immigrant situation, word on the street is that there are 25,000 rooms that have been removed from the supply in New York as of today for these immigrant accommodations, which is creating compression demand and allowing hotels to raise room rates even more. It's funny. I stayed in the city Sunday and Monday night during NYU, and I had a change of plans and wanted to stay in the city last night, Tuesday night. On Saturday, I was on Marriott's website looking for what it would cost to stay. I found a room at a Renaissance Hotel on 35th Street for $3,100, $3,100 for one night. It's crazy.
Wow.
Yeah. So there's a lot of good things going on coming back to your question, in the lodging industry. There's a lot of positive things. When we talk about the transaction side, we'll talk about some of the stresses vis-a-vis the capital markets.
Yeah, absolutely. And before we get there, I still think our fundamentals are strong. I mean, I like the new category bleisure. I think it makes a lot of sense. You and I have been road warriors for I don't know how long, and sometimes it's really nice to extend that trip. I used to do it before the financial meltdown at the Arizona Biltmore for the lodging conference. And I'd come in the weekend before so I could catch up with all my friends from the East Coast who brought their families, and then stay through the weekend after because of all of my West Coast friends and their families were there. So, I think it's STR and everybody else needs to add that as a permanent category because you're not seeing as much business travel, but the length of stays on the business travel has increased. So I think that's something that we need to
Totally agree. And I kind of feel like I may have invented bleisure because when I was a young buck 40 years ago and I started doing what I do, I used to have a policy. If I was getting on a plane that crossed the Mississippi, my ski boots came with me. And back in
Nice.
those days, I used to ski 30 plus days all out west, and I'm based in New York. So that was a beautiful thing.
Well, I know you're not skiing in San Diego. If you are, there's some problems there.
Global
Oh,
warming.
God.
Yep.
So let's talk about construction loans right now. My feeling is, Daniel, that who's ever got the A plus credit and the depository relations, they're still getting construction loans. They're getting money for major PIPs, just the every 5 year PIP because the hotel got beat up, or they're building new projects. They've gone through the entitlement process and they're ready to go. We do hear a lot about, the feds don't have the people that they did in 08. Community banks may be having some issues. You're seeing a lot of construction loan portfolios being sold right now and a few other things. So what is your expert opinion on construction loans for hospitality?
Listen, it's not as easy to find, if you will, as you might find for existing hotels that are particularly cash flowing today. But listen, at the right price and the right basis, everything works, right? So you can find construction financing. It's going to be incredibly expensive in terms of the borrowing costs, and so that has a negative impact on financial / economic feasibility. And because of elevated interest rates is one of the reasons why we're seeing a dramatic pullback in not only availability, but viability of construction financing. So it's out there, but you're going to have to pay dearly for it. And it's probably going to put negative pressure on any sort of economic feasibility for new construction. And again, we're talking generally, right?
Right.
The hotel business always has been, always will be a neighborhood street corner business. So it's very sub-market dependent.
I agree with you. I think, also, you're looking at it and you've got so many new, brands being launched. It's almost back to every day somebody's, launching a new brand, and, select service, extended stay are, really going through almost a renaissance with the extended stay branches of, whether it's Marriott, Hilton, Hyatt, and so on, IHG. Are the lenders right now looking at that category? Is select service more of a favorite child? Is it going to be extended stay? I don't think anybody's really got an appetite for, something like Terranea, which I still think is the last resort of its kind in California that's going to be built. So what are you hearing from the lenders on that in particular?
Well, listen, select service and extended stay, have been hot subsegments for a long time, and they continue to be. And just look at the players in that space. They are smart, sophisticated institutional investors who know and understand the real estate space, particularly hospitality, right? Think Starwood and Blackstone. They love those segments. But I tend to be a contrarian, and I think there's tremendous opportunity to buy existing assets, full service and big box assets in downtown urban cores. San Francisco is getting a terrible rap in the press these days. Listen, unless you think it's physically going to fall into the ocean, San Francisco is a world-class city. Yeah. Yes, it's going through some real difficult times now, but that's more political related than it is, fundamentals. And I think if you're a long-term holder and you buy in markets like San Francisco today at reduced values, there's going to be tremendous upside opportunity. So Park Hotels just announced yesterday that they were giving up on 2 major assets in downtown San Francisco. I'm not so sure that the fat lady has sung and that they will not work something out. They may be posturing. I don't know. But at the end of the day, there's no question the value of those assets today is a lot lower than it was not that long ago, right? So somebody else's problem creates an opportunity for others, right? And look at some of the office buildings that are trading in San Francisco at 35, 40 cents on the dollar, right? I think San Francisco's got a lot of upside that's going to take a long time to achieve. However, again, if you buy with the ability, if need be, to hold for 10 years. I stress if need be.
Yeah,
it's kind of hard to lose, right? Doesn't mean that if a capital event opportunity bubbles up in year 3, 4, or 5 that you wouldn't take advantage of it. Of course you would, right?
exactly.
But and you look at New York City. I mean, some of the trades that have occurred, the Sheraton Times Square. I love referring to that one. MCR bought that for $200,000 a room. That's a lot of real estate for $200,000 a room.
Yeah,
Probably not a whole lot of downside at that basis. So I think there's tremendous opportunity in downtown urban 24/7 markets that not long ago were the darling markets and today are perceived as the dogs.
absolutely. I'm going to agree with you on this 120%. And I was up in San Francisco 30, 45 days ago. And I got to tell you, I was pleasantly surprised. I had jumped on a plane from Hawaii, flew into SFO, loved that airport. SFO, they've done a phenomenal job
Agreed.
repositioning that airport. Got right into the Palace Hotel, had a renovated room. And when I stepped outside the next morning, I was pleasantly surprised. I only saw one area that had a lot of homeless people, but they weren't screaming and yelling at you like they do when you're downtown LA. Now, I was born and raised in LA, and I'm sorry, but that downtown market needs some substantial help. The restaurants, everybody, it just had an air to it. Like, it was getting ready to start hitting on all 8 cylinders again. And I'm very familiar with the Park 55. I'm also familiar with the Hilton and Union Square. They're both tremendous hotels. I do have one complaint about the Park 55. As you take the escalator up to the second floor, the check-in desk is right there. So if they're backed up getting people checked in, it's jamming up everybody on the escalator. Move the front desk, okay? Easy fix. But I think you're right. And I think, with the capital stack, and this is where I'm going next, is, it's unrealistic. And unfortunately, we've got a lot of people that have retired in our industry and the other parts of commercial real estate. You cannot have commercial loans at par with a residential loan. And basically, that's what we've been seeing for a very long time. And it's not sustainable. 2, it's not realistic. And, what Branch was out there at, 3, 4, 5%, we were good, take advantage of it and move on and enjoy the ride with that. So what are you hearing on the capital stack right now? We're taking a little bit of a pause on interest rate hikes. We've still got some things going on out there. Debt and equity, it's our lifeblood for transactions.
Great and timely question. Listen, I'm not an economist, so I'm not going to really venture on interest rates other than at a high level. Listen, word on the street is that they're about to take a pause, right? The Fed, that is. But it may not be over in terms of their desire to continue to raise rates to push down inflation. I don't think interest rates are going down dramatically anytime soon. I think they may, a year from now, be a tad lower than they are today. And in terms of availability, again, there is debt out there. There's no ifs, ands, or buts about that. The challenge that many people, investors, perceive is that it's not free money anymore, right? What was going on 18, 24, 36 months ago was a real anomaly in that you could borrow money at ridiculously low return rates. If you look at interest rates going back 40 years, where we are today, everything's relative in life, right? It's definitely higher today than it was 18, 24, 36 months ago, right? But if you look at the 40-year average where rates are today, it's not that out of line. So debt is available, but again, you have to pay an appropriate return on that debt today, whereas not that long ago, it didn't cost a whole lot. So that's sort of the shock to the system. And the markets have kind of frozen up a little bit. listen, we've seen this movie several times now, Craig. You and I have been around, right? And the first couple of transactions that break the logjam, there's so much equity out there, so much equity that was raised during COVID in anticipation of what never happened, right? The can got kicked down the road. Well, guess what? The can is so far kicked down the road, there's no more can left, right? And so this current wave of maturities that's coming is going to finally cause a tremendous amount of transaction activity, which again, for existing sponsors could be, a challenge and maybe even some losses, but it's going to create tremendous opportunities for investors coming into the space. And God knows there's a ton of equity on the sidelines, chasing yield. And if you think about it, if you sit on cash in today's inflationary environment, you're losing money every single day you're holding cash, right? So there's pressure to get that money out.
I agree with you again. And, this is going to kind of tie into your early statement about, one of the services you provide with the newbies coming into the hospitality sector. Our fundamentals are strong. Multifamily and light industrial are no longer the favorite children out there. I truly believe hospitality is. Granted, our deal flow is slowed down, but that's a temporary scenario. So helping the newbies come in, and I think on the asset management side is the right way to go. I've worked for a couple of management companies, and watching the sausage being made on site, I much more enjoyed the asset management side than the day-to-day ops. So talk to us about that and how you're helping, the new hotelier, somebody that's coming in and going, look, this is an asset class that we haven't really looked at. We had a lot of multifamily. We think there's some crossover there. We had offices. How's that working?
Extremely well for us, actually, because there's quite a bit of new players coming into the space. And listen, one of two things happens. The folks who have never really been involved in hotels before, and they initially approach their first hotel investment as, well, it's just another food group of commercial real estate, no different than an office building or a shopping center. Well, there's a huge difference. And the folks that end up approaching it that way, tend to learn hard lessons. And then there are those who know what they know and those who know what they don't know. And they recognize that hotels are a very different commercial real estate asset class, right? The fundamental premise of daily leasing of guest rooms, and with technology being what it is, the ability to reprice rooms by the nanosecond, which, by the way, in an up market's a beautiful thing. In a down market, it'll kill you, right? That alone is, positions hotels very different than a 10-story office building with 10 long-term tenants that have 10-year leases, right? Once you lease up the building, you know what your revenues are going to be every single month. And then it's just a matter of clipping coupons, right? With hotels, you have not only putting heads in beds, very different income streams, food and beverage, right? Which is a very different sale than putting heads in beds. And then the costs associated with food and beverage versus rooms. These are completely different businesses. Then there's the group meeting and the banquet business. So hotels are very complicated businesses, very complicated going concerns that are married up with bricks and mortar real estate. So we work with these newbies to the hotel space and help them figure out, highest and best hotel use, right? Select service versus full service. If it's full service, should the F&B be outsourced on a management contract, or should the F&B be leased, right? Should a hotel be, branded or independent, right? Should it be brand managed, or should it be managed by a third-party independent operator under a brand? And so we help folks figure out the answers to all these questions, and then we run processes for selecting an operator, selecting a brand, negotiating the business points of these deals. That's what we do. We help developers with a lot of developers who are looking at existing office buildings. Who would have thought that hotel would be a favored asset class over office? It was kind of mind-boggling. But there are a number of folks out there looking at office buildings that have sort of reached the end of their economic life as office buildings, and what do we do with them? And hotel is a conversion opportunity in many cases, as is residential, right? So we help these folks figure out the answers to all these questions. We are hotel experts. We're not retail experts. So if hotel doesn't work, we send them off to some other alternative use expert.
There you go. Now, I always love a hotel enhanced mixed use development. Okay. San Francisco, New York, Chicago, Miami have all done very, very well with those type of assets. And that mixture just works really well in a vertical market. Hey, my friend, it's time for our lightning round. And I don't think you played this the last time you were on, did you?
Uh-oh, now you're scaring me.
Well, nothing to be scared of, just a little fun. Producer Danny's going to put 2 minutes on the clock. It's word association. So just the first thing that pops into your head. And we've only had one guest go over 2 minutes. So the pressure's on you to do it in 2 minutes or less. Okay?
Okay.
Here we go.
We didn't prep for this one.
Nope, we didn't. This is a surprise. So 2 minutes on the clock starting now. Capital. It's available. You got to pay for it. Hotels.
I love hotels. It's the best industry in the world. I consider myself so blessed to be in this sector. My middle initial is H, and I tell everybody my parents knew when I was born. Daniel Hotel Lesser. My middle name's Henry.
There you go. Labor.
Oof. Labor is tough, right? It's expensive. It's hard to get by. Unions are a challenge in many situations. But listen, technology's out there, and the hotel business during COVID finally figured out that they need to get ahead of technology instead of being reactive to it. There's lots of opportunities with technology to figure out labor issues.
Perfect. Your favorite band, group, duo, or solo artist?
Grateful Dead.
Nice. I love that. Favorite movie?
French Connection.
There you go. Tequila or whiskey?
How about wine?
There you go. Favorite airport?
None.
Favorite airline?
I like Emirates.
Aisle or window?
Used to be aisle pre-COVID. Now definitely window.
Hotel or resort? Which one's your favorite?
Resort.
There you go. And you did that with 20 seconds left. Very good. All right, my friend. It's time for a shameless plug. Please tell the audience how they can get a hold of you.
Well, you can Google me, that's for sure, and LW Hospitality Advisors, www.lwhadvisors.com. My phone number is 516-456-6959. That's my direct line, and my email is daniel.lesser@lwhadvisors.com.
Perfect. Hey, Danny's dropped in a slideshow that Daniel did for us. And Daniel, if it's okay with you, I'm also going to post it on our media page on the CLIC website. So you'll be able to download it there as well. So thank you, my friend. I really appreciate you coming back on the show. And again, you've got an open invitation to come back anytime you want. Thank you.
Well, thank you. It's great to see you again.
Take care.
Bye-bye.
Thank you, our audience, for joining us today. I'm telling you, I'm so happy we've got all these industry leaders joining us and sharing their knowledge with all of us. And I can't wait to get Daniel back into the studio again for another show. So it's going to be a lot of fun. And I want to thank Red Roof Franchising and Chicago Title National Commercial Services Group, California. Thank you both for joining us on this journey, and I thank you for being part of it. And also remember to subscribe and smash that bell on our YouTube channel so that you're notified of all the updates. We've got some conferences coming up, and I'll be doing some vlogging there. And you can find us on all the social media sites, LinkedIn, Facebook, Twitter, Instagram, YouTube. We're there. So thank you for joining us, and remember to be kind. Share your knowledge. Now go be amazing.